Thank you very much for joining us once again today. This is our 15th lecture on strategic financial management, 11th lecture on working capital, and first lectures on debtor management. So we'll discuss debtor management. We'll see what is debtor management, what are the techniques to manage the debtor, what is the reason of managing debtor, what are the impacts. We'll discuss in detail in the next various lectures. So what is debtor management? They said debtor management is a process of designing and implementing policies to grant credit to the customer and to get money from the customer. Why we are doing this? The reason is to increase the sales, and the reason is to reduce the chances of bad debts. This whole process of designing, the whole process of implementing the policies to grant the debtors, to get the money from the customer with the objective of increasing sales, with the objective of minimizing the chances of bad debts, this is called debtor management. I have summarized the discussion into this chart. Debtor management, the major focus will be on credit control policies. There are two major sections of the credit control policy: granting credit to the customer, debt collection policy as well. In the case of granting credit to the customer, we will look into two major things. First will be setting credit limit to the customer. Whenever we'll decide to set the credit limit for the customer, we will see how to assess the credit worthiness of the customer. Then we'll look into this extension in credit limit that has already been given to the customer. So we'll see how can we extend the credit limit, how can we change the credit policy. We'll look into this as well. So far as debt collection policy is concerned, we'll see amount is being received on timely basis. Then it will be simple follow-up through the email, through the phones to get the money from the customer. Then no problem, we'll look into this as well. In case amount is not being paid from the customers on timely basis, then what are the different strategies available to us to get the money from the customer, which are early settlement discount, credit insurance, factoring, and invoice discounting. So these are the different options available to get the money from the customer. So let's start our discussion with the credit control policy. Credit control policy, there are three different ways of setting the credit control policy. It can be restrictive credit control policy, it can be moderate policy, or it can be liberal credit control policy. In case of restricted credit control policy, companies are limiting credit only to the customer with a strong credit history. If the customer doesn't have a strong credit history, companies are not giving any credit to such customers. On the other way around, in the liberal credit control policy, companies are giving credit to the majority of the customer. The core objective is to gain higher level of market share and to have higher profit margins. So in case of restrictive, company have very strict regulations, strict policies and procedures to award credit to the customer, while in case of liberal, companies are relaxed to give credit to the customer, and moderate policy falls in between the restrictive credit policy as well as in between liberal credit control policy. These are the key factors while setting the credit control policy. These factors are what should be the total credit at the company level, what should be the maximum credit to the customer, what should be the credit period, cash discount, extra capital required to finance an extension in the existing credit policy, what should be the debt collection policy. We have discussed it may be early settlement discount, it may be factoring, so different other modes as well. What should be the debt collection policy, administrative cost of debt collection policy, as ways to implement this debt collection policy. These are the key factors which are always being considered while setting the credit control policy. Maximum credit at the company level. So maximum credit, whenever the companies are setting credit at the company level, companies are doing definitely the cost benefit analysis. What should be the cost and what will be the related benefits? And the major cost in giving the credit is the related interest cost. So company will consider the interest cost, company will consider the increase in sales, company will consider the increase in profit. So this we can say that at least company will try to minimize the cost, company will try to maximize the sales. There will be a point where the cost will be minimum, sales will be maximum, company will set that credit as a maximum level of the credit at the company level. And this credit includes cost as well as just we have discussed like interest cost. So company will consider this cost while doing the pricing calculations of the product that they are selling into the market. Whenever the companies are considering extension in credit, the company will consider related incremental costs with the incremental benefits, and company will take the decision accordingly. Assuming company is thinking to give a credit and this credit will increase in profit will lead to 100. If interest cost is also 100, company is not getting any benefit. So might be the company management will take this decision to move ahead to capture the market, might the company management will not take this decision. On the other way around, if I'm asking my incremental profit is 100, my interest cost is 50, net profit is 50 by giving the credit, then definitely companies will move ahead and company will take the decision to grant the credit to the customer. So the core object, whenever the company is setting the maximum credit policy, whenever the company is thinking to give the credit, company will do the cost benefit analysis. The major cost is the interest cost. Assessing credit worthiness. So whenever the company is thinking to give credit to the customer, company will assess the credit worthiness of the customer as well. So while assessing the credit worthiness of the customer, company will take references, company will check their credit rating from the different credit rating agencies. Companies will set initially low level of credit, then based upon the subsequent payments of the customer, then they will increase the credit. For the large value customer, file should be maintained and all available information should be captured related to the customer, so the company will be able to take decision related to credit worthiness about the customer in the future. We need to look into the press comments as well. These press comments will give us the latest information about the company, and the supplier will be in a better position to assess that they need to give a credit to the customer or not. Then they said company needs to visit to the customer and they need to get first-hand information about the customer before giving a credit to the customer. They said company needs to maintain in-house credit rating system as well based upon the individual customer, based upon their home owner status, customer age status, occupation status, qualification status, and companies needs to give a specific points to these variable factors, and based upon these variable factors they need to do the rating. What are the customer they needs to give it on priority. Extension of the credit. Now the credit has been given to the customer and customer is asking for extension in the credit, or company is thinking to change the credit policy. In case the company is thinking to change the credit policy, they said the company needs to look into the extra sales, incremental profitability, average length of the average debt collection period, and required rate of return of investment. So these will be the factor. Based upon this, company will assess the need to change the credit policy or not. We will look into this in detail in the next example. Let's take this example. This is Russian-based company is considering a change of credit policy. They are thinking to change the credit policy, which will result in increase in average collection period from 1 month to 2 months. The reduction in credit is expected to produce an increase in sales each year, 25% increase in sales as compared to the existing sales volume. Selling price of the product is $10, variable cost is $8.5, and current annual revenue sales is $2.4 million. Required rate of investment is 20%. Assuming that 25% increase in sales would result in additional inventories 100,000, additional account payable 20,000. The company is asking, the company needs to give this offer to the customer. If all customers are availing this extension in credit, or only new customers are availing this extension in credit. So we know this existing revenue of the company is 2.4 million, price is 10, variable cost is 8.5, my contribution is 10 minus 8.5, 1.5 per unit, 1.5 divided by 10 is equal to 15%. 15% is my CM ratio, contribution margin ratio. So if my sales is going up by 25%, so 2.4 million into 25% into 15% is equal to 2.4 multiply 0.25 multiply 0.15 is equal to 90,000. So 90,000 will be my increase in contribution. If we are extending the collection period from 1 to 2 months, there will be 90,000 increase in contribution on annual basis. So what will be the related cost? So related cost will be increase in debtors, increase in inventory, and increase in account payable. So we'll see what will be the impact on the working capital. So in the first option, this is they have calculated 90,000 my incremental contribution on annual basis. In the first option, we have assumed that all of the customers will take the credit benefits, means their credit period will go from 1 month to 2 months. So 3 million will be my total sales, 2.4 million into 1.25 is equal to 3 million. 3 million revised credit period will be 2 divided by 12. So revised debtor will be 500,000. Existing debtors are 200,000. Increase in debtor 200,000 means 300,000 will be blocked here. 100,000 will be blocked here. We are getting some sort of relaxation from creditors 20,000. So net increase in working capital is 380,000 in the first option. So my investment rate is 20%. So 380,000 into 20% is equal to 76,000. 76,000 is my incremental cost. Incremental benefit is 90,000. So differential is 14,000 benefit in the first option. In case of second option, only new customer will take the benefits of 2 months, but existing customer will keep paying on monthly basis. So incremental sales is how much? 600,000, which is equal to 2.4 million into 25%. So 600,000 will take 2 by 12. My increase in debtor is 100,000, increase in inventory 100,000, increase in AP 20,000. So in net increase in working capital investment is 180,000 into 20% is equal to 36,000. This is incremental cost. Incremental benefit is 90,000. So net impact will be 90 minus 36, 54,000. So either we are, so in case of option 1, either in case of option B, both of the options are feasible for the company. So company needs to go ahead and company needs to adopt this policy. They have calculated the percentage as well. So 90,000 is my incremental benefits, 380,000 my incremental cost, increase in working capital. So return on extra investment is 23.7. Here return on extra investment 50%. Here return is 23. Here return is 50%. In both of the cases, my cost is only 20%. So both of the options are feasible. Thank you very much for joining us. In our next lecture, we'll be focusing on debt collection policy. Thank you. Bye bye. Have a good time.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.